Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's program we have Jun Bei Lu. Now she's looking at arguably her favourite stock in the market right now, following the good inflation number in the US that has sparked a nice stock market rally. She also goes through a number of tech stocks that have great upside potential. And she, in particular, she looks at XERO. Then we have Anthony Doyle of Firetrail Investments, and he looks at the inflation number in the US and the implications for investing overseas. A really interesting interview with Anthony. And finally, Paul Rickard focuses on a company that both he and I like, namely XERO. What's been going on there? Is this a company that we have to give up on or really invest more in because it does have a lot of potential? Now let's kick off with Jun Bei Lu of Tribeca Alpha Plus. Thanks for joining us, Jun Bei Lu.
Thank you for having me, Peter.
Okay, let's talk about that inflation number on Thursday. It must have made you very happy on Friday.
Oh, absolutely. Look at that. That's what we've been waiting for.
Yeah.
And that's what market's been waiting for that softness in inflation and that really putting a rocket under the market. And you're seeing just general buying across every, pretty much every sector, and especially those oversold companies like some of those growth businesses really had a really strong day.
Okay, and are we now awaiting another good one in December? And if we do you think that will lead to a much bigger rally?
Absolutely. So now it's sort of wait and see. We should see a better CPI, but look, market expectation expecting somewhat similar as what it is this month. And if that is the case, it's good enough to really get the equity market to continue. But if we get an even weaker one, inflation coming off even bigger,
like
that would be fantastic.
Number.
Yeah, then that will be absolutely fantastic. But that's not in the expectation. So if we can hold what it is, I think it's good enough to.
Yeah, what we're seeing is product inflation is coming down pretty quickly, but services inflation is a little bit more resistant in the US.
Which is as expected. People are getting out and about, so they bought enough stuff and they want to go out and spend. It really just shows the underlying resilience of the demand, right? People will overspend on travel, will overspend on restaurants and hotels, and quite frankly, that will probably be here to stay for some time. But the goods should come off very quickly, and we saw some of the commodity prices coming off.
Are you positive on the news out of China that they're cutting back on their COVID restrictions?
I think I'm very positive, and I have always believed that China, we passed the Congress now, and it is really a time to focus on economic activity, and that really has been dented by the very strict COVID zero policy. We knew it is a path that government has to take, and it seems to be a little bit faster than expected. And next 12 months, we really should see the economy really reopen. But it might take a few months, for the actual activity to flow through. But that's the path that they have to take.
Do you put a guess in on whether you think the US will get a worrying recession?
I don't think so at this point. I think US, everything's pointing to a moderate sort of slowdown, maybe a mild recession, and I don't think it's a severe one at this point, especially if Fed inflation continue to moderate and Fed has become a bit more pragmatic.
Okay, so therefore you would be factoring in a pretty good year for stocks.
Oh, absolutely. For Australian market, actually, if you look at Australian market returns so far this financial year, it's been quite good. I think it's close to 11%. We delivered just under 15%. And next 12 months is still looking pretty good because we got China reopening. Our commodities should do quite well. Our banks is doing okay, and everything else, that's been sold off should have a better valuation support.
Okay, let's go into some stock analysis as well. Last week, XERO reported, and the market wasn't impressed, underwhelmed, if you might say. Well, what's your take on what's going on in XERO?
Look, at the result actually is a bit better than expected. So in the headline number, it looks a little bit softer, but there was a lot of cost that they put into the first half that the second half is not going to incur. So, when you take out some of those costs, it's more or less in line, a little bit better. So market just didn't like the commentary about second half weighted, right? Market always feel when a company say second half is going to be bigger, to take that as a sort of, let's sell it first before we worry about the next half. So net, I think everything's in line with expectations. People were worried about this economic activity dropping off very sharply in UK. At this point, we actually just had a lot of analysts coming back doing the tour around UK and things. Things aren't that bad, not as the way we see it. So XERO actually still have pretty good momentum, and being a company that's actually taking share, it's not about overall market growth and the like. It is pretty well positioned.
Okay, so on that basis then, at the current share price, do you think it looks like a good buy?
Yeah, absolutely. XERO, you don't buy XERO for next result. You do buy XERO for its longer term growth. And so far, everything's intact. And even if we have a nasty recession, assuming, which I don't think it's that bad yet, but if we do, XERO being one of the fastest growing and well anchored within some of the large business over there, I think they will do very well during the downturn.
Once upon a time, I thought XERO was probably the safest tech play, but WiseTech is looking like a very good play, isn't it? Have you done your homework on WiseTech? Is it a company that's going to do well as growth improves and as tech gets bought again? Is there more upside for WiseTech, do you think?
Look, I think I'd much rather to be sitting in XERO than WiseTech. It's just simply because WiseTech has done very, very well. It's almost close to its all-time highs.
Yeah, and that's why I'm asking the question.
Yeah, so it's very expensive. Look, it's done very well. It's actually thrived throughout that whole COVID period when there's supply chain disruption and people worry about they might lose volume and things. They've done really well and they had really good results. So, it's been an incredible story, but it just does so well and it is very expensive relative to what the likes of XERO and what they're trading at. I'm much rather to put my money in XERO. When the world returns to growth, when things look a little bit better, WiseTech still going to grow as it is, as expected, whereas XERO is going to grow much, much faster than what people expect.
And WiseTech was once criticised by short sellers. There was a problem with the company. Obviously, short sellers were wrong.
They're all gone now.
Okay.
They clearly all folded it.
Let's go to the next interesting one. Audinate. Now, we've talked about Audinate in this program. It's done very, very well for tech company. Do you like the company?
I do like the company. I always believe, I think even from beginning of this year, we talked to two things drive the market. One is, or drive a stock price. One is the reopening theme to that stock, and one is the, the theme, the valuation, if it's really cheap and you can buy that. Now, the reopening theme is Audinate. It was very depressed when everything was shut, no concerts, nothing. And now really coming back to a trajectory where everything's, people want to go out to have experiences.
Yeah.
Or the concerts, it's a shame, Justin Bieber canceled the concert. But there's lots of things happening, and people will pay for those experiences, and that is where Audinate sort of very leveraged to that reopening experiential things. So, for me, this is well positioned and really like this company, and it's still little, but it's the largest in this category.
It's had a big gain, but it's still well below its all-time high, I think.
Oh, absolutely.
And let's go to another one that short sellers didn't like, namely corporate travel. Now, it's done very, very well. But is it overpriced at this level, or it has more upside? I
think the travel agent is looking a little bit tough now. Actually, today we just heard from Flight Centre talking about margin is, it's under a lot more pressure, even though the revenue is recovering. But for Flight Centre, slightly different because they had all their commission cuts from the airlines and things. But things are going to look a little bit harder. All these companies have performed very well ahead of the earnings recovery. Now, the earnings recovery actually now start well on track. But the trick is that corporate travel, obviously being very exposed to the corporate travel spend. A lot of companies now in the US are talking about cutting travel spend from the corporate level. So look, it hasn't happened yet, but probably in the 6 to 12 month time, you will have that earning, outlook started being tapered. So share market always look forward 12 months. So I do think it's probably in that neutral territory or taking profit territory.
Okay, Zip, what do you think?
Look, I think Zip is an interesting space at the moment. I do think, given the amount of M&A in the pipeline, this company probably looking very interesting from a lot of corporate angle. They still have a very large platform, just Afterpay in the old days, and Afterpay is being taken out. I think further down the track, perhaps early next year, when we cleared all that M&A indigestion in terms of loans and things, and next year we should beginning to see a bit more M&A to support its valuation.
Okay, well, let's go to ELO. that's Elmo, it is actually being targeted by private equity now, I think, isn't it?
I think so, yeah.
And EML, that's another interesting company, had so many problems, particularly deciding to go to Ireland after Brexit.
That's right.
Do you have a view on EML?
Look, EML is getting harder because Ireland was considered a separate issue when they thought regulator have problems. Now the UK regulators looking at it, so it does making it very hard to assess what the outcome might be. Maybe outcome will be nothing, just a small fine and things, but we're just very hard to see that. Now it is becoming very cheap, and it is a big beneficiary of high interest rate as well. They hold quite a lot of money on the balance sheet, so very leveraged to that. But it's just in the short term, given management changes and things, that it's very hard to actually make call on where it might go. Even for future M&A opportunity for other people to buy this business, you really need that regulatory uncertainty to be sort of cleared up.
Yeah. Another stock that short sellers got stuck into, namely Tyro. Were the short sellers right there, or was it in many ways the tech sell-off was the problem for Tyro? Yeah,
I think it's the tech sell-off, and I think it did have some issues with some transitioning in terms of and issues with the customer experience. Remember they had a bit of outage, which is
that's when the short sellers were sort of
when they started. Yeah, so look, I think clearly all these names we quoted, short sellers would have lost a lot of money in those names, and Tyro has proven to be, well, it's got a real business. It's got a huge base, and it's got Bendigo Bank, and it's got all these other banks coming on.
Do you think the prices that are being offered right now for Tyro are far too low? The board thinks so.
Look, there is a lot of value in that company. It might take longer. So I think for a lot of long shareholders being sitting on the board, sitting on the register, might feel a little bit impatient. But the company, I know it does have a lot of long runway, although it needs to continue to reinvest, because you don't want its own technology to become obsolete. You don't want to just hold on to the terminal, because now the Afterpay's joined force with Square, and all the landscape is changing dramatically. Tyro doesn't have enough capital to really compete with those big boys.
Yeah, and it's probably why the banks have been sniffing around. I think we've heard that NAB.
That's right, yeah.
I think there was more a rumour, but ANZ or Westpac.
Westpac, yeah.
Yeah, I can see the good sense in a bank looking at Tyro, given its customer base. But you're right, it would have the money, because the challenge for Tyro would have to be at the very small end, where those little square terminals really work for a smaller operation.
That's right.
And Tyro's probably a much higher level business, but still it's a part of the sector they could have got if they'd moved faster and had the money to do so.
That's right.
All right, what's your favourite stock of the week? Which one have either you bought or you're going to buy? Probably you already bought. Which do you think has the most upside in the portfolio?
Ramsay is by far probably the highest conviction at this point. Yeah, absolutely. They just had an update. So clearly, share price is way below its asset value now. It's got a lot of hard assets, and its earnings recovering. And the latest result, the update last week, actually turned out to be better than expected. I thought it would take a whole lot longer for the hospital to return. It's just a matter of time for the earning to return. Waiting list is really long in the public hospital. People will gradually return to those places. So it is very cheap. Significant discount now to the bid, but we're not betting on bid coming back. But it's a premium hospital. Used to trade a premium to the market. Now it's a discount. Earning will grow double-digit for the next many years, just to catch up on all the backlog. Good management team. Great asset.
Sounds like a very healthy tip there, Jun Bei Lu Ramsay. That's Jun Bei Lu of Tribeca Alpha Plus. Joining me now is Anthony Doyle of Fire Trail, and 3 weeks ago he was with us. He was pretty positive and optimistic that everything was heading in the right direction for stocks. He got it right. The big question is, do we stay in, or could the smarties try and sell this one off? Let's see. Good to see you, Anthony.
Hi, Peter.
Well, as I say, you got it right, and as I lied, but you're the guest here, so I can't really boast about me getting it right. But the bottom line is, so inflation has fallen, and the market liked it. The next question is, do we have to get another good number in December for the market to really believe it and get this rally going on And the second part of the question is, well, if we don't get a good one, could the market sell off?
Yeah, well, there's a saying in statistics that one result doesn't make a trend, Peter, and we've had certainly a very good result, resulting in one of the strongest days for the equity markets globally that we've seen since COVID. But we think there's very good reasons that we may continue to see a deceleration in inflation. And like you say, if that feeds through, that's really bullish for the equity market in particular, because it gives investors a sense that maybe the Fed might take their foot off the brake a little bit in terms of raising interest rates and might actually not have to raise rates by as much in order to get the decline in inflation that they're looking for.
Okay. Now, I'm going to reveal something personal about Anthony Doyle, which he'll have to confess to. See, he wasn't always someone working for a fund manager. He used to be a serious economist. Now, I'm not saying he's not serious now, but you were an economist. You didn't have to talk about markets, did you? In the Macquarie days, was it?
Macquarie, yes, correct.
And you were more just pursuing to be right as an economist.
Yes,
as economists try to do, but not always succeed.
Of course, yeah.
And taking all that into account, it's logical for me that there's going to be a whole lot of data drops between that last great inflation number, or better than expected.
Well, better than expected, yeah, exactly. Still 7.7%, still very high.
Better than expected. And the next inflation number, and there's going to be data drops along the way, and each data will be analysed by economists, serious and unserious ones.
Of course, yes.
And they'll be trying to work out whether the next one will have the trend go. And also, you're going to have Fed officials. If you're a Fed official, and a lot of people like your old persona ended up being a Fed official, would you be happy to say, we're off the races? I think they're more likely to be very cautious and jawboning about that. What do you think?
Peter, you're absolutely right. So we've got a couple of analysts at an investment bank conference this morning where there was a Fed speaker talking. And they've reported back to us at Firetrail that one of the members of the Federal Reserve Board has actually indicated that he's not happy with the reaction that has occurred in market. But when we will talk about officials, as you know, economists, we like to categorise officials as to whether they would prefer interest rates to be very high or perhaps they're more concerned about growth. And this official is very, very, what we describe as hawkish on inflation. So he's very concerned about inflation. So he's saying that, as economists do, we will play the long game here. Inflation is still too high. We want interest rates to go higher, and much will depend upon the evolution of inflation over the course of the next couple of months.
So that kind of we call jawboning or...
Jawboning, yeah, exactly.
That is likely to maybe take a bit of the rise out of this rise. But my feeling is, obviously I want your reaction, look, for example, our market's up 11% since October 3 or something like that.
Yes.
And I feel as though there'll be a pullback of some kind until the next inflation number. But then if the inflation number's good, I think we'll take off again. Is that the way you're reading it?
Well, there's been a couple of events just over the course of the last 3 or 4 days since Thursday that has really supported the risk appetite of investors. So investors' willingness to enter into equity markets. It was started off with inflation being better than expected, but confirmed out of China that they are taking steps to move away from their zero COVID policy. Also taking steps to support their property sector as well. So I've been on the show before and I've said that the US sets interest rates for the world and China sets growth for the world. And we also have Biden and Xi meeting today in Indonesia, which potentially suggests some thawing of the relationship that became quite tense during the Donald Trump administration. So there's been a lot of events that have occurred to give investors a bit of hope there.
Headwinds dissipation.
Well, that would be the economists' too technical lingo, but it's starting to line up a little bit for a rally into year end. That Santa Claus effect that we often highlight.
And it seems to me, Anthony, if they get another jobs number which is not all that aggressive in terms of rises and stuff like that, the market will like that. So it's really going to be like a game of ping pong between, can you trust this number? Will it get better? And if it does, I think, so you're happy to pin your without question reputation to the mast that if that inflation number in December is a good one, even a better one, then the market will really like it.
Yeah, I think you're absolutely right there, Peter. And we do think that inflation has probably peaked in that we've seen supply chain issues. They've resolved themselves. If you look at shipping freight costs, for example, we also think that a lot of the heat's coming out of the consumer in the US because interest rates have risen, much like here in Australia. So we do think that potentially you are going to see some really positive news on inflation. And then economists' focus will shift to inflation. Okay, maybe that's a little bit better. They'll shift to what's the state of the labour market and what's the state of the economy in general. The labour market is so important because around 60% of a Western economy like the US or Australia is driven by consumption. So are households tightening their belts or are they continuing to spend freely?
And let's go back to something you mentioned then about China. And how long, if China stops doing its excessive lockdowns, and how long before the greater production that would come from less lockdowns, how long would that then take to give us some cost disinflation, inflation falling because costs are coming down from China? Would you expect that we'd see it by the middle of the year or something like that?
It's pretty quick. If you look at the shipping containers, for example, the big cargo ships, a lot of the wait times going into ports have alleviated to some extent as well. So there would be a lag of between 3 and 6 months, but we've already seen some of those big supply chain constraints really starting to, as I mentioned, resolve themselves. And what we've seen is companies, particularly in the latest earnings season, they've reported they thought that the good times were going to last forever. So they ordered a lot of inventory for fear of those supply chain constraints remaining, and they're stuck with a lot of it on their hands. So they're now starting to try and shift some of that, and they're cutting prices. Or they're really forcing their suppliers to really screw them down on the deals that they've got. So we've seen that across apparel names, we've seen that in consumer discretionary names. So it is an environment where it does look like the consumer is slowing to some extent, and you're starting to see some of those inventories build up.
So in a sense then, the lower inflation from lower costs could show up early next year, which then would take the heat off the Reserve Bank to raise interest rates as fast as it has, because they're fighting the demand side of inflation, but they can't do anything about the cost.
No.
Did you pick up, I think it was in the NAB survey of business conditions, where the comment was from business that business costs are easing, which I thought was a small reference, but a really interesting one, that business would be saying they're noticing that costs are starting to come forward. Wouldn't be energy costs, but other costs.
You're absolutely right. And what we've also seen is migration starting to occur again. You know, that's a real policy pivot that we saw in the latest budget from the new Labor government as well. So here domestically, the RBA, they were the first of the global central banks to say, hang on a second, yes, inflation is high, but we aren't going to be as aggressive in keep on raising those interest rates as quickly as other central banks for a number of reasons. One being the outlook for the consumer, the outlook for the labour market, but also house prices are declining now, and that can, higher mortgage rates, higher interest rates often feed very quickly into a higher cost of living for Australians, and coupled with those energy prices suggests the RBA is right to be tentative in raising rates.
And because most of our Australians are on variable rate mortgages, monetary policy does work faster
very
here
quickly.
than the US.
Yeah, you're absolutely right, Peter. Yeah, so the US is 30-year fixed rates.
Okay, all right. So it's been a very interesting discussion between two economists. He was serious somewhere. I was once serious at the University of New South Wales. Been less serious ever since. But, okay, people watch this show to try and work out how they're going to invest. And one fantastic reaction from Thursday till Friday in the US was the big rebound in big tech.
Yes.
A week or so ago, big tech could be in trouble for some time. And it shows me that if interest rates are going to stop rising in the US, tech's going to take off. Do you think that's right?
Well, we might disagree here, Peter. So we're a bit more cautious. Yeah, we're a bit more cautious on the outlook for the big growth tech names. That's not to say that they aren't fantastic companies. They're big for a reason, and they are great companies. But for us, it's whether they are the valuation is there and whether their earnings will be strong enough to deliver share price gains over the next 3 to 5 years. That's our investment time horizon as professional money managers. So we saw some weak results from Amazon and Meta during the quarter. Meta was particularly hard hit, down 20% in a day. Amazon similar levels. Meta down. So that's Facebook, the old Facebook, down 75% for the year. And the rally that we saw on Thursday and Friday really reflected longer expectations for interest rates to fall at longer maturities. So the reason we're more cautious is we're just finding far better opportunities in other parts of the market. So that's not to say we don't like tech or we don't like growth, but we think that there are other companies there on better valuations. And in the case of Amazon, for example, it's a fairly exposed to the consumer, the US consumer in particular. Got a big cloud business, but as I mentioned, with the uncertainty around the outlook for the US consumer, we've done the work there. We don't think that that's a place that we want to invest right now.
Are you buying any tech, or is it a certain kind of tech? Highly profitable, right space?
We want to see that there is profitable. So the big exposure that we have in our portfolio is Microsoft, for example. So that's a mega cap growth name.
I bet you it's profitable.
It is, yeah. So we want, and the market has really hit those companies that don't have a clear line of sight of earnings and profits within the medium term. They've been hit the hardest. And you've seen a lot of those mega cap growth style names like Spotify and Salesforce, for example, globally, really have a strong focus on cost, taking out a lot of their costs, and we've seen a lot of tech layoffs in particular as a result of that, as they've heard the message loud and clear from share and stock investors, where's the earnings? We're not going to fund this growth for infinity anymore. We want to see you deliver revenues, deliver earnings for us right now.
Yeah, so you guys have a global fund now. Is it hedged, or you hedge it by buying in different currencies and different markets?
Yeah, so it's the Firetrail S3 Global Opportunities Fund. The active ETF, which is the ticker S3Go on the ASX, is unhedged. We also offer a hedged version. So that's if Australian investors want to make a call on the strength of the Aussie dollar. The active ETF is unhedged, but there is an unlisted unit trust which is fully hedged.
Okay. And what do you think is going to happen to the dollar over the next year?
I think there's a strong case, particularly with some of those early tentative signs of stronger Chinese growth potentially, that you see strong demand for our commodities, and as a result, stronger dollar. So I think that it's not that the Aussie dollar has been weak. If you look at a basket of traded currencies, our most traded partners, it's actually what grabs all the headlines and what investors need to look beyond is the strength of the US dollar, which reflects much higher interest rates in the United States. So if we start to see, again, going back to the initial start of our conversation, inflation starting to become more manageable, interest rates potentially petering out at the back end or middle of next year in the US, then it looks like the big run-up that the US dollar has had, that might actually begin to peter out, and the Aussie dollar might stand a good chance of actually appreciating next year relative to the USD with that strong demand for our commodities.
And when you throw in the fact that US interest rates are either going to stop rising or even fall, that's another good thing for the dollar. Great to see you, mate.
Cheers, Peter. Thanks.
Anthony Doyle, Firetrail. Joining me now is Paul Rickard of the Switzer Report, and I wanted to talk to him about XERO. This is a stock that both Paul and I like, and we've said we think it looks like great value. But he's done some homework, dug deep. So what's the latest on XERO, Paul?
Yeah, I mean, XERO had a bit of a tough week last week, Peter, because of it announced its first half profit result, which, look, I think the market was really sort of a little bit concerned about the what's going on in the UK and the US. And look, we all know XERO's been fantastically successful in Australia, and New Zealand. It just dominates the accounting software market. And actually produced some pretty good results, but not only subscriber growth in Australia and New Zealand, but also was able to increase what we call ARPU, or average revenue per user. That is
the money they can drag out of a
column. And that was up quite a bit, largely because of a bit of a price increase, but also because people are using their platform more for other things, payroll and also some other
They're
functions.
selling other functions.
Other functions.
Yeah.
But most of their expenses, Peter, are actually going into expansion into the UK and US. And you might say, well, how can a Australasian, I'll call Xero Australasian, they are from New Zealand, but we like to think
Without
of them
us, they wouldn't have really made it.
we like to think of them as Australian, but they are from New
It's
Zealand.
like Russell Crowe. He's in New Zealand, but he wouldn't have made it without us.
Succeed overseas. It's a tough market. Aren't there already good accounting platforms and so forth? Well, there are, but it just so happens that we're a lot more advanced in terms of the cloud, and what Xero's been able to add, leaves some of their rivals, looking really second rate.
Yep.
But the problem with that is they're big markets. They take a lot of marketing dollars. They're hard to crack. It's hard to get change amongst accountants and their clients. And the growth in the UK and the US has been a little bit disappointing. So that was sort of behind the sell-off last week. It bounced back a bit on Friday because we saw the tech rally. But if you look back over the course of the last since the start of the year, amongst the major cap technology stocks, Xero is down a bit over 50%. Actually, a company like Computershare is actually up. Altium has only lost 19%, and WiseTech's only down 1%. So amongst the leaders, Xero is the real laggard.
And we often thought Xero is probably the best tech company in the country. Isn't it?
Yeah, and I think that's partly a function of the market re-rating certain tech companies in terms of multiples. So-called sort of enterprise value to sales multiples have really come down globally, and Xero, being in that sort of business, being in the software as a service business, has really suffered. But I think it's also because it really hasn't delivered as well as it should have offshore, and the market's now looking at it and saying, well, why are you spending so much offshore if you're not quite getting the growth? So the growth, on headline numbers looks okay. It's just that it's not meeting quite market expectations, and that's really behind the share price fall last week.
And obviously, this was a pretty ambitious program to take on the Poms and the Yanks, and in the middle of it was COVID as well. So it wasn't like it was an easy marketing introduction to those important markets. So Paul, you've drilled into it, and as I say, like you and I, we both think there's a good company of the future, and we kind of would have thought it was probably getting close to $100 by now. What your work you've done today, what's your conclusion on the short term and medium-term prospects for the stock?
Well, let's start with what the brokers think. The brokers are still pretty positive on Xero. So consensus target price is around about $85 to $87. That compares with a market price now of 70. So the brokers think there's about 20% upside. Yep. Now, in saying that, they have all been bringing their target prices down throughout the year. Yep. The consensus target price was a lot higher a couple of weeks ago and a lot higher a few months ago. But the brokers think there's upside. Secondly, you've got to say that the company's been remarkably successful in Australia and New Zealand, and has the fact that it can grow revenue here, despite what you think is almost saturation coverage, and grow customers. It's doing pretty well. So it has the skills to execute, it has the team to execute, and you've got to think it's probably got the product to execute. So it's just a matter of, well, can it do it in the US and the UK? Now, there were some circumstances, there's some tax changes in the UK that were delayed and a few other things that just caused accountants to sort of slow down. But I think, the market wants to see Xero do better there. And that's probably the biggest factor that would cause a re-rating of Xero. So I think it's probably okay at these sort of prices, Peter. I mean, I've been long a lot from a lot higher up. I think this is the sort of price where you cautiously add some more. But I don't know whether you're going to see an enormous re-rating in the short term. So if the market sort of really loves Xero again, I think one of two things has to happen. Either we see a lot better penetration and take-up rate and success rate in the US and UK, and we're probably not going to see more stats on that for another 6 months or close to that. Or secondly, the whole global technology sector has to re-rate. And that might happen once the market is convinced that inflation is actually down. So I think that's the upside case. And as I said, the brokers think there's value. So there's clearly people like you and I saying there's a bit of value in Xero, and that can provide.
And I'm sure some of those brokers even have a bigger rise ahead than the 20% average.
Yeah, they do indeed, Pete. And look, and to Xero's credit, it has been. Look, it is very aware of that the market now wants, I won't say profitable tech companies, but it wants companies tech companies that are either, if they're growing, they've got to grow quickly, and you've got to show that the reinvestment of the dollars is wise, and there has to be a pathway to profitability, and there has to be, they want strong cash flow. And Xero is making headways on both, but I just think it needs to go harder, and that's what the market wants to see.
It's funny, as I listen to you, Paul, and you think about their attempts to break into the UK and American markets, I'm just thinking, they are potentially a takeover target from a private equity firm, aren't they?
Yeah, look, they are, Pete. I mean, because half their customers are offshore, and so there's a lot of opportunity. I mean, just to sort of give you the numbers around that, about 57% of Xero's revenue is in Australasia, and that's 40% of the cost base. The other 43% of the revenue is in offshore, and it's 60% of the cost base. Yeah. So that's where all the money is going. Going overseas, and as they develop their product and develop their sales and marketing effort, they're just not growing quickly enough, and that's what they need to do. And you say, well, why bother to go overseas? Well, there are two reasons. A, that the size of the markets is just so much bigger than what you can get in Australasia. And secondly, we're actually quite advanced in terms of adoption of the cloud in some software and some of the features. So in terms of a product, whole cloud accounting platform, they're actually more advanced than most of their competitors in those markets. So the opportunity's there, it's a matter of execution.
And they wouldn't have benefited from a lower dollar either, would they?
Yeah, look, they measure it, of course, in Kiwi dollars, so there's obviously some issues there. But I think that the market's not unhappy with Xero. It's just that it can, at the moment, where tech is, I won't say it's on the nose, but people aren't falling in love with it. The market can be fairly circumspect, and it's just some of the fundies are saying, well, we like the Xero story, but we want to see some more progress before we're really going to get back into it.
And they are competing against other firms that might look more attractive in the short term.
Yeah. So tough road ahead, but not an impossible road. And I think they're a company I'm going to back.
Are you going to buy more, Paul?
I am. I think you've got time on your hands a little bit, because I don't think we're going to get the re-rating in the short term. All technology could go up, Pete. I mean, of course, if we get a second inflation figure in the US,
that's good.
That's really good. The whole market could turn on itself again. But I think there's time with Xero. But I think it's a company to back, and they've got announced the appointment of a new CEO as well. So
a female.
Yeah, and she's coming out of the States, so clearly she's going to be, as I understand it from what the Xero is saying, spending most of her time in Northern California.
Yeah.
Well, not most of the time. She's going to be based in Northern California and obviously commuting to Australasia and other markets on a pretty regular basis. But it does show you where they're trying to head. Yeah. And they've gone for a person that thinks it's going to drive that.
What is the name of the new CEO?
Sukhinder Singh Cassidy. She's arriving in November, takes over on the 1st of February, replaces Steve Vamos. And so, look, that's where I guess Xero's betting on the fact that it's going to make it in the US and the UK. And I think, we've got to back companies like that. But, it's got to start to also demonstrate that it really is making enough headway.
Yeah, I think, obviously Xero did well here under Vamos, but I found him to be quite an invisible leader. Didn't get out there and talk about his business enough. I hope this new CEO does that. I do think it's a good company, but it has let us down. That's Paul Rickard. If you want to know more and want to read his story, go and sign up for the Switzer Report at switzerreport.com.au. And that's the show for tonight. Thanks for joining us. Remember, if you want to know more about stocks you can invest in, and you want to know more about different sorts of stocks we might not have talked about on the program, have a look at the Switzer Report, switzerreport.com.au. Thanks for joining us. See you on Thursday.